Welcome back, everyone. Markets processing a big week in economic data after the Fed's rate rises and jobs data out this morning, certainly being digested here even as we go into the Friday trading session. And the losses are accelerating for the major averages as we've been tracking. Also checking in on U.S. Treasury yields. Let's now turn to how Treasuries are faring. Analysts are recommending a late cycle playbook with global growth at risk to downside shocks and inflation. To talk about where markets could go next, we have Erin Browne, PIMCO Portfolio Manager. Erin, great to have you here with us this morning. I mean, we're taking a look at Treasury yields, of course, but again, keeping this all in mind with how the markets are digesting the economic data and the headline number that came out this morning on the jobs data as well. You know, how do you read into this reading? 428,000 jobs added during the month of April.
No, I don't think that this is materially different than certainly what analysts were estimating. It was certainly slightly better in terms of the absolute number, in terms of job gains in the month, and average hourly earnings, and the participation rate was slightly weaker. But I do think that this is largely in line with what the Fed articulated as the base case, and I do think that this keeps them on course for continued tightening over the next several months. I don't think that this accelerates it or sort of pauses it either.
So, Erin, hey, it's Julie. It sounds like you then don't think that the last couple of days in equity markets shows the Fed has a messaging problem, or do you?
No, I don't. I mean, certainly coming out of the Fed meeting, the markets were quite happy with the Fed messaging, with it being a little bit less hawkish than maybe some had feared in the market. But I think that once people sort of stepped away and we came into yesterday, the trends that have been in place, I think, remained intact. And I don't think that the Fed materially altered, what the market narrative is out there right now. We're still in a late cycle environment. Inflation is still above the comfort level of global central banks, and the Fed needs to tighten into that. And I think with real yields as low as they still are today, and with market liquidity as robust and ample as it is out there, the Fed is tightening into, still a decent market environment where, despite the fact we've seen certainly volatility over the last couple of months, the absolute level of either yields or of stock prices is still okay. And the household is still in decent shape, and corporates are still in decent shape. And the Fed has the ability to tighten into that environment. And I think they're taking advantage of that right now.
Erin, a contact slipped me an email this morning saying that it's dangerous now that it appears the Fed no longer has the back of markets. How do you think about that?
I think that's right to some extent. Look, we've been in a decade plus period where the Fed was the ultimate buyer of assets, and they certainly created the Fed put out there in the market that helped to boost stock prices. But remember, we've been in periods like this over the last 10 years. You think about the taper tantrum, you even think about the environment immediately prior to the onset of the pandemic, where the Fed had tightened rates, and it created volatility along the way. And certainly for risk assets, and we're in that type of environment now. It's not uncharted territory. Perhaps that the Fed put has set lower, just given the fact that inflation is running as high as it is. And right now, the Fed has moved from what has been a very growth supportive environment to an inflation fighting environment, which is the problem that they're grappling with right now. And that is sort of accelerating the U.S. economy into a very late cycle environment, which does have meaningful implications for what your expected returns are across asset classes.
Well, and it also has implications, of course, for where you should be putting your money here, Erin. So if you're looking late cycle, if you're framing this as late cycle, what tends to do well or perhaps less badly in late cycle?
You're absolutely right. So firstly, you have to keep in mind that volatility in late cycle environments is going to be higher, and your expected returns are going to be lower. What you want to put your money into are inflation hedging assets. So that's either buying commodities outright or owning stocks that are levered to higher commodity prices, like the metals and the mining sector. You want to stay away from companies that are high importers or high users of raw material costs. So some of the consumer discretionary names you mentioned, some of the clothing and retail names that have gotten hit hard, that have high cotton costs or high, production costs because of raw materials, those are all going to come under pressure in this environment. So really like the sort of more industrial and metals and mining levered names, and don't like some of the retailers and some of the consumer staples name here. Another sector which I think is really undervalued right now, where there's opportunity for outperformance, is the healthcare sector. And you've seen pretty strong earnings reports across the board from the pharmaceutical companies and the healthcare service names in the first quarter earnings. And those names, I think, have been underappreciated by the market. They, sort of underperformed last year because of the boost that they got in the very early COVID wave. And now I think that they're really poised to do well, given the fact that they have strong earnings growth, strong free cash flow generation, and very importantly, in late cycle environments, low earnings volatility.
All right, we'll leave it there. Erin Browne, PIMCO portfolio manager. Always good to see you. Have a great weekend.